OG John AG, before anything else, how are you doing? And I mean that genuinely, not as a formality. These markets have been brutal. The uncertainty is real. The noise is deafening. A lot of people are scared right now, and that is completely understandable. Drop a comment, tell me where you are at, because the whole point of this channel is that you do not have to navigate this alone. I spent 2 hours going through every single comment from the last video. Everyone. And what kept coming through over and over was not panic about the pullback, not questions about price targets. It was people showing up with a genuine desire to understand, to actually learn. That is it. That is the only thing I ever needed to see. And if you are one of those people, this channel is about to get very valuable for you. Now let's get into the market first, because the data from this week demands it before anything else. Gold is at $5,098 Western spot. China reopens Tuesday. After Lunar New Year, and the first thing that emerged from the ground level is that multiple gold shops across the country stopped selling bars entirely. Contracts signed before the holiday are being refunded, not delayed, refunded. When a seller hands your money back, rather than sourcing the metal, that is a physical shortage expressing itself in the most direct language possible. This is not a forecast or an analyst opinion. It is a physical delivery failure in real time in the world's largest gold-consuming country. And here is what makes this remarkable in context. Gold was already at $5,098, with China essentially offline for the entire week. The conventional logic said the absence of China's demand engine would put pressure on metals. Instead, gold held and moved higher, absorbing a Supreme Court tariff ruling, policy uncertainty, and a dollar relief bounce without breaking. Now, China is back and cannot source physical metal to sell. The ones who read the demand data already understood why this was the likely outcome. On silver, the picture is equally significant, but for a different reason. Managed money long positions in the COMEX silver contract, the speculative funds that chase momentum and amplify moves, are sitting at their lowest level in 20 years, below even the depths seen during the 2008 crisis. Silver just moved 16% off its weekly lows, and the speculative crowd is not here yet. That is the signal the informed minority understands. When the momentum chasers eventually arrive to a market running on 20-year low speculative positioning, the move that already happened will look like the pre-game warm-up. The structural backdrop behind both metals connects to something bigger. The US dollar's share of global reserves just hit its lowest level in 32 years, now sitting at 56.9%, down from 72% at the peak. Central banks are not cutting dollar exposure because they read a newsletter. They're doing it because US debt trajectories, persistent deficits, and long-term credibility erosion have made the shift unavoidable. Meanwhile, investor and central bank demand for gold has averaged around 610 tons per quarter over the last 2 quarters, 230 tons above the threshold that historically drives roughly 3% quarterly price appreciation. The math behind gold at these levels is not mysterious. It is documented demand running well above the historical trigger point compounded by a supply structure that cannot meet it physically. Now here is the mid-reveal. The layer most people watching this market are still not connecting. There is a $2 trillion private credit market that has been quietly funding AI infrastructure build-out, data centers, computing capacity, the physical backbone of the artificial intelligence wave. One of the key lenders in that system manages approximately $273 billion in assets. It recently restricted withdrawals from a $14 billion retail fund. When a fund restricts withdrawals, markets immediately ask whether the fund has enough liquidity to meet obligations. The companies borrowing from this system carry extreme debt loads to build infrastructure that may not generate cash returns for years. If AI revenue growth disappoints on timeline or magnitude, the stress does not stay inside a tech stock. It migrates into credit. And private credit is not a niche. It is $2 trillion of pension and insurance capital deployed into illiquid structures. Simultaneously, the U.S. pending home sales index just printed an all-time low, down over 43% from its peak, with contract closings falling more than 8% in a single month. The housing market is frozen, credit is showing early stress signals, and gold's volatility has just hit its highest level since the global financial crisis, which is the market pricing tail risks that have not fully materialized yet, but are visible in the data to anyone looking carefully. Robert Shiller in Irrational Exuberance wrote extensively about how markets reprick risk assets before the broader public recognizes the shift has occurred. We are watching that repricing happen in real time in gold and silver, while the mainstream is still explaining it away as tariff noise. Now I want to address something directly because the comments from the last video made it clear this community is ready for it. Someone wrote that technical analysis does not matter, and honestly, they are not completely wrong. If you are a long-term investor, your time frame absorbs a significant amount of noise, and pure fundamentals can carry you far. The serious long-term money, the kind with real conviction behind it, still runs sophisticated technical systems, not because the fundamental thesis is in doubt, because knowing precisely when to add and when to wait is its own edge. There is a meaningful difference between being right about the direction and being positioned correctly for the timing. Now, if you are trading shorter time frames without technical analysis, you are not just at a disadvantage, you are operating almost blind. There is no other way to put it. What actually works is the combination. Fundamentals tell you what, technicals tell you when. When those two things align simultaneously, when the structural deficit thesis meets a specific price structure on the chart at the right moment, the conviction becomes unshakable. Nobody can talk you out of a trade you understand completely from both angles. That level of clarity takes time to build. But with genuine desire to learn, 6 to 12 months is enough to get there. I have seen it happen with people who showed up knowing almost nothing. Here is what most people miss about technical analysis. And this connects directly to what has been happening in silver over the last few weeks. Price action has memory. There are patterns that repeat consistently, not randomly, but at specific times, specific sessions, specific days of the week, specific weeks inside the monthly cycle. That repetition is not coincidence. Whether you call it algorithmic behavior, institutional positioning cycles, or systematic market structure, the label does not change the reality that it is observable, consistent, and usable once you know where to look. The ones who saw the bullish swing failure pattern forming at $72, who marked the inverse head and shoulder structure before it played out, used that information. They were not reading headlines at that moment. They were reading the structure of price itself. And the structure was telling a completely different story from what every commentator was saying. That is exactly what we are building here. Not followers, thinkers, people who can walk into any market environment, pull the primary data, read the technical structure, and arrive at an independent conclusion without needing anyone's permission to have conviction. Now let me give you the honest resistance case, because that rigor is what separates this from every metals hype channel you have probably encountered before. Gold at 5,098 with crisis-level volatility means sharp pullbacks can happen at any moment without a change in the underlying fundamental picture. Markets running hot volatility are markets where fast, deep moves occur in both directions. Silver's 16% move off the lows creates a pocket of short-term traders sitting on gains who will exit into any credible negative headline. The private credit stress, while visible in the data, has not yet produced a visible bankruptcy event. And until it does, institutional capital may remain in risk assets rather than accelerating into metals. Jim Rogers in Hot Commodities documented how commodity bull markets experience violent corrections that shake out the impatient even when the multi-year structural thesis remains completely intact. Silver dropping from 120 to lower levels and still closing green on the month is exactly that dynamic in real time. The structure held. Most people's conviction did not. This is financial warfare education, not investment advice. Every decision is yours and yours alone. The counter is straightforward. Gold has outperformed the S&P 500 on every major time frame. 1 year, 5 years, 10 years, 25 years, every single one. And the mainstream financial advisory industry largely pretends it does not exist. That is not an oversight. That is a structural conflict of interest that delays institutional flows and then creates an accelerated repricing when those flows finally arrive. Silver miners are sitting only 14% from their all-time highs, while spot silver itself remains 44% below its nominal peak. That divergence, equity, markets pricing in higher future metal prices before spot has fully caught up, is a technical signal that people who read intermarket analysis understand immediately. The silver market has now printed 10 consecutive green monthly candles, breaking an all-time record. Ask yourself this. They crashed silver from $120 all the way down, and it's still green for the month. How much physical demand is sitting underneath this market if that kind of forced selling cannot produce a red monthly close? Here is what this means. Taken together, the physical gold shortage in China post-reopening is not a rumor. It is a delivery failure expressing itself through contract refunds. The dollar is at a 32-year low in global reserve share, with central banks actively reducing exposure. Silver's speculative long positioning is at a 20-year low even as the market prints 16% weekly moves, and a $2 trillion private credit market is showing early liquidity stress at the same moment the U.S. housing market hits an all-time activity low. These are not separate stories. They are the same story told in different asset classes at the same time. Invest with logic, not hype. OG out and about.